Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. This is part 3 of a 3-part series I've done where I've really tried to demonstrate a couple of things, and I want to just kind of refocus that with this final installment. Number one, it is a market of stocks, not a stock market. There's a lot of difference between the individual companies that trade in the market, and in spite of the market crash we've recently had, there are stocks that remain very, very pricey, in fact, significantly overvalued in many cases. And what I wanted to do is just give you all a perspective, because I believe that investors should think about the individual things that they own. I always say, mind your own businesses. In other words, pay attention to the things you own and don't worry so much about the overall market. But having said that, in every market, there will be overvalued, undervalued, and fairly valued stocks. So what I'm going to cover here are the final 10 stocks. And I'm just going to do a brief overview. I'm going to look at them from a standpoint of adjusted operating earnings and just show you what the valuation looks like. Actually, I'll take that back. I am going to look at Amazon from the perspective of cash flows, and I'm also going to take a look at, of course, Digital Realty, which is a real estate investment trust, and Crown Castle based on funds from operations, which is the primary way that you look at real estate investment trusts. Actually, I've got Equinix and SBA Communications on here as well. So otherwise, I'll be looking at operating earnings. So let's start with Nvidia, and it's obviously a very popular stock. The company manufactures powerful computer graphics processors, amongst other things, and I find it a very, very interesting stock because, first of all, it's had tremendous long-term growth on average. I want you to notice that the growth rate here going back to 2001 has been over 22%, just under 23% per annum. And I do want you to notice, though, there was a period of time where growth wasn't so stellar. It was spurty. During the recession, they had some down years. Earnings growth was also very, very weak in 2003, 2004. This company, by the way, has a January fiscal year. I do want you to notice that. But look how the stock price has tracked the company's earnings. It's almost a quintessential example of that. Coming out of 2016, we had this huge surge in growth. You can see growth rates of 138%, 79%, 44%. And of course, the stock price reacted dramatically. Then along comes a down year, minus 13%, and the stock price collapsed. And then we start getting some pretty good growth again, and now we've had the stock price rising again. So this company is literally running according to how the business is performing. Now, they actually have a very good dividend record as far as growing their dividend, as you can see by the white line here, but they offer almost no yield. It's less than 1%. But this is clearly a very pricey stock, and I do want you to notice that the last time they had this growth surge, it did end up in a significant drop. In fact, let me calculate that for you. You can see that Nvidia's price dropped by 52% from August 31st, 2018 to December 31st. So when you're dealing with high valuations like this, that kind of stuff can happen. The next stock in this group of 10 I'm going to look at is MSCI. They're most famous for their GICS partnership with Standard & Poor's, and MSCI have produced the GICS, General Industry Classification System. And that's something, by the way, that FastGraphs will be displaying here coming up in early May, but right now we're still using FactSet industry classification. But I want you to notice the company's had tremendous and very consistent growth, averaging about 17% per annum. That's very, very attractive. This PE ratio line here is 16.7, or just we'll call it a 17 PE. The normal multiple for this company has been about 26, but all of a sudden, with no real tremendous change in the company's growth rate, let me shorten this graph for you so you see that the growth rate is around 20%. So that is a little bit of an increase, but nevertheless, the price has gotten extremely high here. So I would consider this an excellent company that's currently overvalued. But I do want you to notice that this company has gone through the coronavirus like it wasn't there. The next company I'm going to look at is Rollins. You would know this from, the famous Orkin Man commercials, if you will. Again, I want you to notice the company has a very good historical growth rate, averages about 17% a year. The company has 30% debt to capital, no credit rating, but they also have a very good dividend record. I want you to notice their dividend has increased. But this is a stock that the market has put a 30 multiple on over time, which I consider too high, but all of a sudden now we've got a 61 blended PE ratio, and this, to me, this stock is just ridiculously overvalued. It's hard to figure sometime why the market does this, but nevertheless, it does. This is an extremely expensive stock today. It did have a drop from 2018 coming into 2019, but you can see that during the virus pandemic here and the economic shutdown, the company's actually done real. The next company I want to look at is, I'm going to use funds from operations here, is Digital Realty Trust. You can see the company has a really excellent dividend record. Their dividend has grown by about 11% a year. Their FFO payout ratio is attractive at around the 60% range. I did want you to see that. I do want you to notice how the price got above and below its orange earnings, or in this case, FFO justified valuation of 15. You can see that's been a very consistent baseline. When it gets below that, the stock typically rallied back. But for the last several years, we've had this very, very high valuation, and that's in spite of FFO dropping ever so slightly, expected to drop. So I think this stock is vulnerable. I think it's extremely pricey. I wouldn't buy it here, but for disclosure, I am long this stock, and I've owned it since it was undervalued back in here. My next company is another, I'll call it technology REIT, if you will. Crown Castle International. Cell tires, fiber. I mean, it's really a major REIT. And again, I want you to notice that we've had this very strange situation during this raging bull market here. To me, this is unbridled optimism, where this company is traded at around 22 times FFO, which has been historically normal for the company. It currently trades at a price to FFO almost 28, so I do consider it clearly overvalued. I do believe it's only worth 15 times FFO, and you could see that has been a very good standard up until we got into this, late stages of the bull market. But anyway, the stock has held up extremely well. They have a nice dividend and nice dividend growth record, but almost a 3% yield. But I do consider this stock very pricey. But it's another one that has gone through the pandemic as if there wasn't any stress on their business. My next example is ServiceNow. It's a company that engages in cloud computing services and so on. I do want you to notice this company is a very strong grower. And in fact, you might have noticed as I've gone through this list of these 10 stocks, all of them have been very, very fast growers. Let me try to get a growth rate here that makes sense. This company has been growing since 2016 at about 50% a year. It trades at a very, very high valuation, but this company does have some really strong long-term growth potential, but I do believe it's very pricey, even with considering the growth it has. It pays no dividend, trades at almost 85 times earnings, which is just insane in my opinion. But it's a very exciting, solid company with a lot of growth potential. And again, it's relatively new. It's only been a public company since 2012, but the track record has averaged about 38% a year. So this has been a really great holding for the growth-oriented investor. Next company I want to feature is Netflix. Of course, everybody knows Netflix. It's another one of these really strong growth companies, no dividends. I do want you to notice earnings growth has been extraordinary at about 31% a year. The stock is trading at a very high valuation. But what's interesting about a growth stock like this, if you look at the forecast for the 3 to 5 year trend line growth rate, it's 36%. Now, if it traded at 35 or 36 times earnings, that would generate a 15% long-term rate of return. If it continued to trade at the valuation it currently is trading at, it would give you an opportunity for almost a 36% annualized rate of return. Now, personally, I don't think you're going to see it trading at these high valuations, but this company does have a lot of growth potential. And you might notice most every stock I've shown so far has had pretty good historical growth characteristics. The next company, of course, is the 800-pound gorilla in retail, Amazon Corporation. And what I want you to notice is the company's earnings record has been relatively sketchy. And now more recently, they've started to really generate some very strong earnings. But given that, the stock trades at almost 100 times earnings, 98 times earnings. But watch what happens when you look at Amazon from a standpoint of cash flow. This has really been a cash flow story thus far. And if you look at Amazon based on its record, if all of a sudden the stock looks actually reasonably priced, and it has been trading at a multiple of about 25 times cash flow, and you look at forecasts, the cash flows continue to grow at around 24% a year. So a strong case could be made that even though Amazon trades at a very high valuation based on earnings, based on cash flow, it's probably now just what I call a fully valued stock, or fairly valued even. It's not way overvalued like some of the others I've shown you so far. The last two companies I'm going to show you is Equinix, which is another data center real estate investment trust. Once again, I want you to notice this stock is trading at a very, very high valuation relative to historical norms. It started paying a dividend in 2015. The dividend has grown from $6.76 a share to over $10 a share expected for this year. It is a data center REIT. REITs have been hit especially hard in this market in many cases, especially REITs in retail and hotels and things like that. But Equinix is actually obviously held up very well, but it's extremely high in terms of its valuation relative to its fundamentals. And then last but not least, I'm going to show is another real estate investment trust. SBA Communications is considered a wireless infrastructure trust. Again, another kind of technology oriented. Once again, the company's had a good long-term record of growing their business, their FFO. They only started paying a dividend this year that's currently yielding about less than 1%. The payout ratio is very low, but you can see that the stock has been another growth situation. So I think to kind of close this video out, what you've seen here is you've seen 10 stocks that have very strong growth characteristics, and those have held up very, very well in this market from a positive point of view, but from a negative point of view, they're also very, very pricey. I'm not sure. They're all great companies, and if they can all be bought at the right price, I think they would be very attractive long-term investments. But I would caution you to look real closely at these stocks and consider the fact that the market is valuing them at what they often call in the industry a greater full valuation, where you would foolishly pay more than the stock is worth on the basis that a full greater then you will eventually come along and pay you more. Anyway, this has been Chuck Harv. I hope you enjoyed this series just to give you a perspective that, it's not everything in this market is bad right now. There are some stocks that are extremely strong and have extremely strong valuation. So be careful out there, and I hope you enjoyed this series. If you like what you saw here, please subscribe to our YouTube channel. I appreciate it, and I got more videos coming. Thanks.